Okay, let's talk PLUG. Is this thing a rocket ship fueled by clean energy dreams, or is it just running purely on speculative fumes? Maybe some of that cheap Fed money. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks.
And today we're doing a deep dive into Plug Power, that's ticker PLUG. We're using our research captured this morning, September 22nd, 2025, to really dissect the, explosive moves we've seen. This company, I think, perfectly captures that tension we see so often in the market right now between, the big vision and the hard numbers.
Yeah, and the macro backdrop is definitely setting the stage for that tension, isn't it? We're starting the day, feels a bit risk-off across the board, but everyone's still kind of buzzing from last week's big catalyst, that Federal Reserve interest rate cut.
Right. Lower rates make borrowing cheaper, and that just juices the perceived future value of these really aggressive growth companies like PLG that need tons of the capital.
So let's start with the exciting part, the story side of things. You've got this compelling vision PLG is painting in the hydrogen space, and last week that story translated into a, 44% stock surge? Fueled by the rate cut, sure, but also some new deals.
The extended partnership with Uline, that logistics giant, and a new venture they announced down in Brazil. It's a powerful narrative. Definitely hooks investors.
There's always a but, isn't there?
Well, yes. If you connect that vision to the, let's say, harsh reality of the balance sheet, that narrative kind of deflates fast. Our fair value analysis, it shows the stock is significantly overvalued, like way overvalued. Because the earnings and cash flow are so negative right now, the calculated fair value actually ends up deep in negative territory.
Whoa, negative fair value.
Yeah, and look, it's not just some accounting quirk. It's because the company needs massive ongoing investment, and frankly, their current sales just don't support the, $2.18 market price right now. And you see this confusion reflected on Wall Street too. The analyst consensus is basically just hold, kind of weak. And sentiment's actually soured a bit over the last 3 months.
Okay, so the bean counters are definitely sounding the alarm. Let's shift gears then. What are the traders actually doing? Because that's where all this crazy volatility is coming from, right?
Exactly. And you see the split perfectly in how people are betting. Options traders. Surprisingly bullish, actually. The put-to-call ratio is low, down at 0.55.
Okay, break that down. Low put-to-call means?
It means for every bet placed that the stock will fall, a put option, traders are buying almost 2 bets that the stock will rise, call options. So that signals some real short-term optimism there.
But wait, if the fundamentals are that bad, negative value, accountants screaming, why are options traders still betting bullishly? Is that just retail hype, maybe?
Well, that bullishness is squaring off against something equally huge on the other side, short interest. A staggering 30.4% of all the available shares are being shorted right now.
30%, that's enormous.
It's exceptionally high. A massive, aggressive bet that this company is going down. And this huge disagreement, the options optimists versus the short sellers, that's what creates this perfect engine for volatility.
And the irony is those short sellers could actually fuel the next leg up.
Precisely. That's the fascinating part. If the price does start climbing, maybe on more news or just momentum, those shorts eventually get squeezed. They're forced to buy back shares quickly just to cut their losses. And that forced buying creates this huge feedback loop. That's your classic short squeeze mechanism. It's like throwing gasoline on a fire.
Okay, so forget the P&L for a second. Let's look at the charts. What are the technicals actually saying right now? Because like you said, momentum seems to be everything at the moment.
And the technical picture right now is overwhelmingly bullish. After a long downtrend, a really key long-term trend indicator just flashed a powerful reversal signal. And crucially, this rally, it's backed by high volume, a big influx of buying pressure, which confirms that, yes, buyers are firmly in control of this recent move.
Right, so that's the critical piece for you, the listener. The technical breakout looks real, it's confirmed by volume. And that massive short interest we just talked about, it's sitting there like preloaded rocket fuel. The market, it seems, isn't trading the 2025 balance sheet right now. It's trading the momentum and that squeeze potential.
So that leads to the key question. What are the strategic levels you need to watch? Well, the critical battleground now is defending the $2 level. That was the key breakout point from this recent move. Our clear invalidation level, the point where we'd say, okay, this breakout has failed, is a decisive close below $2. But as long as $2 holds, the path seems technically clear to retest those recent highs, up near $2.30.
So Pulling it all together, PLUG is sitting at this really fascinating crossroads, isn't it? You've got undeniable technical momentum fighting for its life against fundamentals that are, well, screaming caution. That's quite a situation. Definitely a powerful thought to take away there. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.